Good afternoon. My name is Trevor Williams, and I am an audit partner with Gelman, Rosenberg & Friedman CPAs. Excuse me, and I will be the moderator for today's webinar entitled Title II, CFE 200, Uniform Administrative Requirements, Cost Principles, and Audit Requirements with a deeper diver into procurement and subrecipient monitoring. We have presented several presentations on this topic, and after reviewing the results of the surveys completed after the presentations, it is our understanding that many participants wanted us to continue educating them on the intricacies of uniform guidance. We hope today's webinar will assist you in implementing those new rules and regulations. The first slide contains some administrative items with respect to the webinar. If you experience any technical difficulties, please refer to this slide. If you have any questions, please submit them using the Q&A function, and we will try to address as many questions as possible at the end of today's presentation. I would like to get started by introducing the presenters. First, we have Terry McKnight, CPA. She is a partner at Gelman, Rosenberg & Friedman CPAs. In addition, she has been the director of the firm's audit department for over 13 years. Terry has more than 29 years of accounting and auditing experience. Her primary focus has been auditing and consulting for organizations within the nonprofit industry. Next, we have Jennifer Arminger, CPA, CFE, who was just recently promoted to audit partner at Gelman, Rosenberg & Friedman, effective January 1, 2016. Jennifer performs financial audits and employee benefit audits for nonprofit organizations. And finally, we have Amy Boland, CPA, audit partner with Gelman, Rosenberg & Friedman, with more than 22 years of experience in auditing and public accounting. She performs audits on behalf of most federal agencies and with our international private voluntary organization team to assist clients with global activity in strengthening field office controls and grant compliance. All three distinguished presenters conduct numerous audits in accordance with generally accepted accounting principles and government auditing standards that have required compliance with OMB circulars and now under the new uniform guidance. Over the past year, they have presented several webinars and have given in-person presentations regarding the different subparts of uniform guidance. Today, we will again be addressing Title II, CFE 200, Uniform Administrative Requirements, Cost Principles, and Audit Requirements with a deeper dive into procurement and subrecipient monitoring. I will now turn it over to Terry.
Thank you, Trevor. We will first start off with a quick introduction of why and how we ended up with uniform guidance. It all started when the Executive Office of the President issued a memorandum to the heads of the executive department and agencies declaring its commitment to reform the federal government to stop waste and inefficient and ineffective government spending. The administration launched its campaign to cut waste via the Accountable Government Initiative on June 13th back in 2011. And as a result, created the Governmental Accountable and Transparency Board, also known as GATB. GATB quickly realized there was a need to create a formal body to oversee the federal grants and cooperative agreements. They also identified the need to make it easier for recipients to learn about and apply for federal assistance, as well as to understand the benefits they and the country as a whole will receive as a result of spending this federal money. OMB created the Council of Financial Assistance Reform, COFAR, with the job to give recommendations to OMB on policies and actions necessary to effectively deliver, oversee, and report on federal awards. The Council is comprised of OMB controller and senior policy officials from 9 other federal agencies. 8 of those agencies are those that provide the largest amount of financial assistance. It's the Department of Agriculture, Department of Education, Department of Energy, Health and Human Services, Homeland Security, HUD, Labor and Transportation, and the 9th agency is from one of the smaller groups, and this position for the first 2 years was held by the National Science Foundation, and then it was transferred over to the State Department. Other stakeholders involved that has provided feedback was the Council of Inspector General, auditors, recipients, subrecipients, and groups representing them, including the AICPA. So OMB, with the help of COFAR, spearheaded the creation of uniform guidance to combine, streamline, and address policy problems and gaps that were in the circulars. The second slide provides a couple of key dates that we just wanted to bring to your attention. First and foremost, OMB issued their final guidance on December 26, 2013, and it is Title II, Code of Federal Regulations, Part 200, Uniform Administrative Requirements, Cost Principles, and Audit Requirements for Federal Awards. Because it's such a mouthful, everyone does refer to it as the Uniform Guidance. Over the next year, COFAR published the Frequently Asked Questions, also known as FAQs, to provide additional context and background to the Uniform Guidance. The FAQs are really a great resource, and I do recommend you go back and read them if you have not already done so. The Joint Interim Rule became effective December 26, 2014. That is a very key date because it also includes the agency implementations and a few technical corrections. A couple of the shoulds that were noted in the document were transferred over to a must. So shoulds was a best practice, but must means you must do this and to be in accordance with the new guidance. And then later in 2015, COFAR issued additional FAQs, and then the Federal Register notice was issued in September of 2015. Now this notice is where you will find the second year extension for implementing the procurement standards, which of course made a lot of non-federal entities very happy with that second year deferral. This next slide provides the location where the individual federal agencies have adopted uniform guidance, and we thought we would share this with you as a quick and easy reference tool. So if you go over to the Title II CFR Part 300, you'll find the Department of Health and Human Service where they implemented uniform guidance. And Part 400 is where Department of Ag and so on. So this is just an easy reference tool for you to use as you are working with the different agencies. The new uniform guidance will supersede and does supersede the circulars. And as you can see, under the uniform guidance, it is comprised of 6 subparts. Subpart A is the acronyms and definitions. Subparts B through D are the general provisions and administrative requirements. Subpart E is the cost principles, and Subpart F are the audit requirements, followed up by the appendix. So the old circulars will phase out, and those phasing out timeframes will be based on effective dates. There's not a lot to say about Subpart A other than that there are 44 acronyms and 99 definitions. It is an easy reference tool to use when reading and applying the new regulations. So please keep in mind that that is there for your reference. Now heading over into Subpart B, we start off with the general provisions. And under Subpart B, under section 200.100 talks about the purpose. And it does establish the uniform and administrative guidance, cost principles, and audit requirements for the federal awards to the non-federal entities. And non-federal entities include state and local government, Indian tribes, Institute of Higher Education, and of course the nonprofit organization. It details the basis for collection and submission of information by the federal agencies to OMB and the public, and it also provides policy about the delivery of information to the public. In section 200.101, the applicability, it is mandatory for awards to those non-federal entities that I just mentioned. It is discretionary for the for-profit companies and foreign entities, and of course, there's always exceptions to every rule, and they are noted here in CFR 200.101, Section D, and Section 200.102. And just to give you an example, an exception would be block grants that were awarded back in the 1980s. So in order to apply uniform guidance, everyone must understand the effective dates. As I've already mentioned, the federal agency implemented on December 26, 2014. So for the non-federal entities, Subparts A through E, which are the new administrative requirements and cost principles, will be effective for all new awards issued after December 26, 2014, and to funding increments to existing awards when considered a change in the award. And that's important to focus on because there are some agencies that are considering any type of incremental funding where it is not a change in the award. Here I also want to reiterate that you may delay the implementation of the procurement standards for 2 years. However, you must document that within your internal controls. Subpart F, which are the new audit requirements, does start with December 31st, 2015, year ends and beyonds. So Subparts A through E has already been in existence through 2015, but that Subpart F does not go into effect until fiscal year December 31st, 2015. And I think it's important to note at the very bottom here about subrecipients and those subawards. Those subawards follows the effective date of the federal award from which the subaward is made. And that's a very important note to make. And it also follows the requirements of the original award from the federal awarding agencies. So the award flows down to the subaward. So to reinforce the understanding of the implementation dates, we have 3 different scenarios that we wanted just to kind of go through and to make sure everybody is understanding to when to apply which audit and admin and cost principles. So under scenario 1, there's a nonprofit ABC with a fiscal year ended September 30th of 2015. They received 1 award and it was a new award that was received on January 15th of 2015. So breaking it down, your fiscal year end is September 30th, so it would apply under the old OMB Circular A133 because it's a September 30th, 2015 year end. However, the new award that was received after the December 26th timeframe, which was January 15th of 2015, so therefore they would have followed the administrative requirements and cost principles under the new uniform guidance. So in scenario 1, you're working with both the Circular A133 as well as the new uniform guidance. In scenario 2, the nonprofit ABC has a fiscal year end of a June 30th, 2015. They received 3 different awards. The first award is a new award received on December 15th, 2014. Award B was received, new award, on March 25th of 2015. And the third award was an incremental funding to a March 2014 award they received on January 15th of 2015. So again, breaking it down, the fiscal year end is a June 30th, 2015. Therefore, they would also follow the OMB Circular A133. The first award, it's a new award received prior to December 26th, so it would still follow the old circulars, and in this case, since it's a nonprofit, it would follow the A122 cost principles and the A110 administrative requirements. Award B was received after the December 26th timeframe, which was March 25th of 2015, so there it would follow the uniform guidance, administrative requirements, and cost principles. And that third award C, because it's incremental funding and it's to a March 2014 award that was received after year end, the answer here would be it depends, because I didn't give you enough information. Because if the grantor has not specifically stated that the incremental funding is a change to the award, you need to go back to the grantor and get clarification. And we do recommend that you get that in writing from your grantor. If the grantor considers it a change in the award, it would follow uniform guidance. And if they did not, it would follow the old circulars, A110 and A122. We have found that over this past year, working with our different nonprofits, that the federal agencies are not consistent with this. There are some that are moving directly into uniform guidance and some that are not. So don't just assume if it's not specifically stated. We do recommend you go back to the grantor. And then in scenario 3, the nonprofit ABC has a fiscal year end December 31st, 2015. So here they would follow the Subpart F of uniform guidance when applying the audit. The first award was received, a new award, on February 3rd, 2015. Again, that would follow uniform guidance, the cost principles, and administrative requirements. And that second award, Award B, it was incremental funding, which they did not consider it to be a change in the award. And they received it on January 10th, 2015, to an original award dated back in January of 2014. Then the award was passed to a subrecipient on January 31st, 2015. So because it was not considered a change in the award to that incremental funding, it would follow the old circulars, A110 and A122, for the cost principles and administrative requirements. And the subrecipient, even though they received it January 31st, 2015, would follow the circulars as well, because remember, everything follows the original award. So the original award was using the circulars, therefore the subrecipient must follow the cost principles and administrative requirements for those old circulars. So hopefully these 3 different scenarios have given you an indication of how over the next several years you can be applying some of the cost principles and as well as the administrative requirements still under those old circulars until everything gets phased into the new uniform guidance. And this next slide just gives you the answer key to the 3 different scenarios if you're looking at this at a later date. So getting back into the general provisions, the section 200.112 does talk about conflict of interest, and it specifically states in the uniform guidance that you must establish policies regarding conflict of interest for those federal awards. And recipients must disclose in writing any potential conflict of interest to the federal agency or pass-through entity. There are also mandatory disclosures. Recipients must disclose in a timely manner in writing to the federal awarding agency or pass-through entity all violations of federal criminal law involving fraud, bribery, or gratuity violations. Now we're going to go into the next subpart C, which are the pre-federal award requirements. And I think it's important to note that the federal government does issue over $600 billion in federal assistance on an annual basis. So the federal agency and pass-through must decide on the type of instrument for the federal award. Is it a grant, a cooperative agreement, or a contract, which is in accordance with the Federal Grant and Cooperative Agreement Act? They may also use fixed awards if the following conditions do apply. The amount is negotiated using the cost principles. The project scope is specific, and if adequate, cost is based on an estimate of actual cost. Payments are based on meeting specific requirements. Accountability is based on performance and results. You cannot use fixed awards if the program does require some mandatory cost sharing or matching. If the fixed awards, you must certify in writing that the project or activity was completed or the level of effort was expended. If the required level was not carried out, the federal award must be adjusted. There may be periodic reports required, and changes in the principal investigator, the project leader, the partner, or the scope may need to get prior written approval. So under section 200.202, the federal awarding agency must notify the public of federal programs in the catalog of federal domestic assistance maintained by the GSA. The information provided to the GSA must include the program description, purpose, goals and measurements. Where appropriate, these elements should align with the strategic goals and objectives. It should identify whether or not the awards are made on a discretionary basis or by federal statute, the projected total amount of the funds available for the program, any anticipated source of available funds, the general eligibility requirements, and the applicability of the single audit requirement as required by Subpart F. Under Section 200.203, for those competitive grants and cooperative agreements, the federal agencies must notify and announce the funding opportunity. For those competitive grants and cooperative agreements, they must design and execute a merit review process for application. And that pre-award risk assessment, they will review things such as the financial stability of the organization, the quality of the management system, the history of performance. They'll look at those prior year audits for any type of findings noted, and of course, suspension and debarment. So continuing, under Section 200.206, it does talk about the adherence to the Paperwork Reduction Act. Under Section 200.207, they may impose any type of specific condition or additional requirements. Under Section 200.208, unless prohibited by federal statute, federal agencies and the pass-through entities is authorized to request certifications and representations on an annual basis. The uniform guidance does specifically talk about those pre-award costs. It is addressed in the cost principles under Section 200.458, and we'll address that later in the presentation. I'm going to skip over 200.210, and it's going to be on the next slide, and go directly over to the public access to award information, which can be found at www.usaspending.gov. And of course, Section 200.212, the adherence to suspension and debarment regulations. They did implement the executive orders, and these regulations does restrict awards, subawards, and contracts with certain parties that are debarred or suspended. And going back to Section 200.210, it is the list of information that must be included in the federal award. So they're very specific at what needs to be included. So down the far left side, you'll see 1 through 15, starting off with the name, the DUNS number, the FANE, the award date, the period of performance. You should include the start and end date, the amount of the federal funds obligated, the total amount obligated with the total amount of the federal award, the approved budget by the awarding agency, any type of cost sharing or matching if applicable, the description of the project, the name of the award agency, of course the CFDA number and name, and this is what I really like, the award, whether or not the award is research and development. So now there's no more having the entity try to determine whether or not it's an R&D award. It will be specifically stated in the federal award information. And the last, on number 15, the indirect cost rate for the award, and it will also include if the de minimis rate is charged as a part of this award. It must also incorporate the general terms and condition, and the administrative requirement, the national policy requirements, and the applicable terms and conditions. It will have any type of specific terms and conditions also noted, and the federal award's performance goals and other requirements addressing the timing and scope of those expected performance. And again, everything flows down to the subaward agreements. So if you are receiving an award and passing it through to a subaward, you must include these same elements within your subaward agreement. So now we're going to get over to the highlights of Subpart D, the post-federal award requirements, and I'm going to turn that over to Jennifer.
Great, thanks so much, Terry. As Terry mentioned, we're now going to cover some key topics under Subpart D. So after you receive your federal award, with a highlight and a focus on those procurement and subrecipient monitoring standards. However, before we do that, the first topic within Subpart D are some terms on general financial and program management of your award. The federal agency must manage and administer all their awards to ensure that the spending is compliant with not only statutory but national policy requirements. So what that means is that there are any specific requirements, that does need to be communicated to you all, the grantee, the recipients of the award, through either the grant agreement or external communications. And this also does include reporting under the Transparency Act, or FFADA, which many of you may be aware of, dictates some additional reporting if you are subbing out federal money. You would be required to report back on the amounts of those subawards and some key points on executive compensation. So further into some of the rules of performance management, first, an organization must use the approved standard forms that the federal awarding agencies have issued. So as an example, the standard form 425 would be used to report financial information. And this is in an attempt to streamline the process, to be able to harvest data and make those reporting across entities more comparable. You must relate financial data to performance accomplishments, which, as we go through the remaining items and you read the additional guidance within the regulations, you will see that this is the focus of the performance management section, is that they are really trying to link the financial expenditures with the results of the program. So that means providing cost information to demonstrate the effective practices of the program and to be able to improve the outcomes of the programs for other entities. So sharing that information, what you were successful in, what you weren't successful in across the industry, to ensure efficiencies on all levels. And finally, an organization would work with the agency to adapt reporting frequency that is appropriate for them. It could be more frequent for a more complex program, or less frequent for a less complex. So for the financial management system of an organization, first and foremost, we talk about a couple exceptions here and there. This would be one of the exceptions we see for states. States would expend federal monies they receive in accordance with the state laws, so in accordance with the rest of their state funding. However, all non-federal entities are then subject, all other non-state entities are subject to these new financial management system requirements. And when I say new, you know, a lot of these were incorporated into the previous circulars, and they've been best practices that the organizations have been using for years. So an organization must have a financial management system that is able to identify within that system all of the federal awards received and expended and track them separately. So a unique identification number, incorporating the CFDA number, whether it's a pass-through funding or the name of the federal agency in which it's being given from. Not only should they be able to track the general information of an award, but ultimately the more important part is the financial information, and be able to produce financial records that accurately discloses the results and identifies the funding and the expenditures. They must have effective internal controls and accountability for all those funds. And that could be other funds. That doesn't mean it needs to be cash, but ultimately if you receive property or goods, you would need internal controls and a financial management system in place to track those assets. And ultimately, the financial management system should be able to produce reports in which they can compare expenditures with those program budget amounts. And the last two items, written cash management procedures and written policies for allowability of costs. So again, these are things that most organizations that receive federal funding or a large amount of federal funding have in place or in practice. However, the guidance does specify that these now must be written and documented within your finance and accounting manual. So next, the guidance talks a little bit about a requirement for an organization to establish and maintain effective internal controls. And here, for the first time, we see them actually suggest a framework for us to use. It says it should be in compliance with COSO, so the Internal Control Integrated Framework, or the GAO Green Book, which governs internal control for the federal government. So again, a lot of us have been following COSO for years as a best practice, but here they're suggesting that we do use this framework, or if we're not using this specific framework for our internal controls, that we're using something similar, meets the same requirements. Just briefly touching on that internal control framework, COSO, there are 5 interrelated components, and within those 5, there are multiple objectives and principles, which we're not going to go into all of them, but I do think it's important to kind of highlight what those 5 components are. And it gets you into the mindset of, how does my organization kind of fit into this framework? The first being just a general identification of the control environment or the tone of an organization, what we might hear in the industry called tone at the top. What does that look like for our specific organization? The next being the risk assessment. And this is a look at your internal and external risks that are specifically relevant to your organization. So some organizations might have political or socioeconomic or foreign risks, and it doesn't need to be the same for every organization. As a matter of fact, it wouldn't be. But you are required to go through the analysis to identify where your risks are internally and externally. And the next step would be the control activities, which is the implementation of the policies and procedures that are put into place to mitigate those risks of the organization. The next being information and communication, how all of this is disseminated within an organization and how the data flows through an organization. And then finally, monitoring. And this would be monitoring all these components over time. Any organization is not static, it's changing, and it could change all the time. So ensuring that we are constantly monitoring these and our policies and procedures and our internal controls to ensure that they are truly effective for our organization. So interesting that they specifically pointed this out in the new regulations. We like it. We've all been using it in practice for a number of years, so excited about that. Moving on to just some other general items related to financial management of an award. Section 200-304 talks about the awarding agency does have an opportunity to require some bonding or insurance or both. Again, that would be a specific requirement within your award agreement. Section 305, payment. Now this talks about actual payment from the federal government. And again, we go back to there's always an exception. So here for states, they're going to be governed by the Treasury State cash management agreements. But for everyone else, we're subject to the requirements within 305. And I will say that the requirements in 305, there's a lot more information than is highlighted here. So I would recommend that you take a deeper dive into that on your own. But ultimately, the general overtone of payment, the overall requirement on cash management is to minimize the time between when you receive the federal funds and when those funds are used. So we don't want to be holding on to federal monies. We would want to minimize the time lapse. And again, as Terry mentioned, since these all are pass-through flow-down requirements, if we receive money and then turn around and sub that money out, we are responsible for making sure that our subrecipients are minimizing the time in which they expend those funds. So important to note there. The next section, 306, discusses cost share and matching, and that in general, a non-federal entity, a nonprofit, an organization would not be required to put in cost share and matching toward the program unless it was specifically in the notice of funding opportunity. So even before you receive a federal award, the agency is going to put out their notice of funding opportunity, and it would say in there that there would be a matching and or cost share component to the award. So you would be well aware of that requirement in advance. Next, the federal and non-federal entities are encouraged to earn program income to offset costs of the grants. So again, that's income that's directly generated as a result of carrying out a federal program. One example is that maybe you host a training and you charge a fee for that. You know, the cost of the training is paid for by the federal award, but the revenue generated from taking training registration fees would be considered program income. That money could then be used to reduce or decrease the amount of cost towards that program. And that's not decrease total amount, that's decrease the federal portion of the share. So you would still be able to expend the additional program income to cover costs. The next item is recipients are required to report deviations from budget, scope, or objective from their project. The important thing here, and again, this section has a lot more information in it, but the theme is anytime there's a change in scope of the project, that definitely needs to be reported back. Within that, we also see that there's an opportunity for the agency to put into the agreement a waiver for prior approval of certain items. So one of the things that we probably all see most often is that they can waive the requirement that you would need to reach out to them to transfer any direct costs between budget line items that are less than 10% of your total budget for the award. So if that's written into your agreement, you would not need to go back to the awarding agency to get approval to do that as long as it's below that 10% threshold. So that does give us a little bit of leeway. Another item that they recently added to this opportunity for waiver of prior approval is pre-award costs. And that's incurring costs up to 90 days prior to official awarding of the grant. So again, those would be specifically pointed out that those prior approvals would be waived. And finally, Section 309 talks about period of performance. So start and end date of the grant, you ultimately can only charge within that period of performance unless you have a waiver, a cost extension, but you cannot charge beyond the final date of the award. So that wraps up a very high-level overview of just some general financial management, the systems in place for any organizations that receive federal funding. The next section, Subpart D, discusses property management. So the definition for equipment hasn't changed from before, so we like consistency. This still says a piece of tangible personal property that has a useful life of more than 1 year and a unit cost exceeding $5,000 would meet the definition of equipment. So it is important here to just highlight that it is per unit cost. So oftentimes what we'll see is if you buy 5 computers for $2,000 each, that's $10,000 for total order. However, the unit cost of those computers are $2,000. So ultimately, under the federal regulations, that does not meet the definition of equipment. Section 310 does say that an organization must provide insurance coverage for all real property or equipment that they have acquired with federal funds. So 311 talks about real property. So if we purchase or construct real property with federal funds, that title vests with the nonprofit, but as long as you're using it for its original use. So let's say you received money to construct a building or a home to shelter low-income housing, low-income families. That title will always vest with the nonprofit as long as you are continuing to use it for that purpose. The minute the purpose changes, then you would be required to get in contact with the federal agency and see how to treat the property. The next, any federally owned property that an organization is just using would remain vested with the federal government. And then Section 313 talks about our equipment. So our equipment purchased with federal funds, again, these vest with the non-federal entity, so the nonprofit organization. So the nonprofit is required to maintain some very detailed records on the equipment that we purchased with federal funds. And there's a whole list within the guidance on the details that these records must include. Some of them being like where it's located, the condition it's in, a unique identification number. It's several items that must be included in there. And the guidance does say that a physical inventory must be taken once every 2 years. So this is an at minimum, at least once every 2 years. You can implement a more frequent inventory process on an annual or semi-annual basis if you like, but it is required at least once every 2 years. And finally, disposition of equipment that was purchased with federal funds. Ultimately, first, you're going to look to see if you can use the equipment for another program or project funded by the same funder, and then it would be another federal funder. And then if there's no further use for the equipment, you would then request disposition instructions. These could ultimately be in your agreement upon awarding, or if it's silent, you could reach out to your funder and ask what you should do with the equipment. They have 120 days to respond So if they respond, you would then follow what they say. But the guidance does say that if ultimately there is no response within 120 days, you would then go ahead and keep that equipment and reimburse the government for its fair market value at that time. So they do say that that is the default treatment. And finally, within our property management standards, it did give some great clarification for us on, again, those things like computing devices. So those $2,000 computers or smartphones and tablets, these are considered supplies. They specifically point out these items, so we were happy that they did that because there were a lot of questions before as to whether these should be tracked as equipment. All right, so on to everyone's favorite topic, the new procurement standards under uniform guidance. So first and foremost, states are going to follow their existing procurement procedures in accordance with state provisions. So again, the states are an exception to the rule, but they've had strict procurement standards in place for many years, so they would continue to follow their existing policies and procedures. However, the rest of us who are not a state are subject to these new requirements. Some of the general items around the new procurement standards, they must have documented policies and procedures. So your procurement policy must be documented and must be in compliance with these new rules. You're going to need to maintain oversight for your contractors. So we can't just procure a good or service and then hands off. We're going to want to monitor their performance and that they're performing in accordance with the terms of the purchase order or the contract or whatever that may be. So as Terry had previously mentioned, now an organization must maintain written standards of code of conduct covering conflicts of interest. So it became important at the organizational level before, and now here it becomes even more specific within the procurement function of an organization. So the employees who are engaged in that procurement process are specifically required to disclose any real or perceived conflicts of interest with vendors that maybe you're doing business with or maybe soliciting from. Additionally, it's also important that other key employees within the organization disclose any potential conflicts of interest. So ultimately, the organization needs to have policies and procedures in place to receive that information and then mitigate that risk if any conflicts do occur. Some of the next couple items are pretty intuitive. The organization should avoid any unnecessary or duplicative purchases. You would want to create as much efficiency as possible. If there's an opportunity to share goods and services, that is encouraged, as well as encouraging using federal excess and surplus property instead of purchasing that new property. And finally, there's a section within 318 that talks about using value engineering clauses in contracts. And this is pretty specific to construction contracts. So if you have a construction contract, this may be in there, but it's an analysis of each task within that construction process and identification of any cost efficiencies that can arise within each task. So you're also required to use responsible contractors. Again, intuitive, but this also might not always mean that it's the lowest price contractor. You know, you would want to choose a contractor that has good administrative practices and sound business judgment. So ultimately, it's not always about lowest price. And then the next is my favorite, it's documentation. So you must maintain records and documentation of our detailed history of the procurement process. So when in doubt, always document, but specifically they say it must have the rationale for the selection of the contract type and what the basis of that selection was. So we'll actually come back to that in a little bit. So competition, the whole premise on which procurement is based is it's this opportunity to competitively bid out a good or service in a full and open market. So allowing the opportunity for cost efficiencies, competitive bidding, but it must be in full and open competition. So the solicitation that you're doing for a good or service cannot, it needs to be done in a manner that it doesn't place limits or undue restrictions to limit that competition. Now, you are specifically going to put clear and accurate description of the requirements in your solicitation, but no limitations, and they give a specific example of like geographical location limitation, something like that. So the solicitation process would identify those requirements that must be filled and other factors that will be used in evaluating the bids, but no restrictions. And then finally, you must ensure that any pre-qualified lists of persons include enough qualified sources. So again, just this whole section, which if you dive deeper into the guidance, is just very focused on the full and open competition and receiving bids from a minimum number of sources to make a good and efficient cost decision. Okay, so uniform guidance gives us now 5 methods in which we can procure goods and services. So let's start with the micro purchases, and this would be the purchase of supplies and services under that micro purchase threshold, which it actually is $3,500. That was raised. So anything under $3,500, you can purchase, acquire without any sort of quotation or price consideration if it's reasonable. So, so we like this one. We don't need to do anything if it's under $3,500. Still ensure it's reasonable, but no documentation. So next we go to our small purchases, which the guidance then identifies anything between that $3,500 and up to the simplified acquisition threshold, which is $150,000. So anything between that range, we are going to need to obtain price or quotations from an adequate number of qualified sources. Okay, so what does this mean? Well, first it says up to $150,000. That's a pretty large amount. You know, these ultimately will be modified to a policy specific for your organization. So you, as management, would decide what number up to $150,000 is a good number for your organization. So let's say it's $50,000. $50,000 is your threshold. Between $3,500 and $50,000, you'll need to go out and obtain some sort of quote. Now, you'll see here, it does not say a formal process. So we can go online and obtain it. We can get it from an email. We can pick up the phone and make a phone call to obtain this information. So this is not the formal RFP process that we will shortly discuss. But the key here is that regardless of what method is used, you must document this. So if you called up 3 sources and discussed with X, Y, and Z, and they told you this is the price for A, B, and C, this must be documented. So you don't need to get formal RFPs, but you must document the conversation. And again, you would still need to document your rationale on why you selected either A, B, or C. So in practice, this can be as simple as create a 1-sheet form with 3 sections, or maybe your personal policy is 5, and then a section on a conclusion as to why you chose the vendor that you did. The next section, sealed bids, is mostly seen in the construction contracts. Excuse me. So these are when we publicly solicit a firm fixed price contract for procuring construction. Must have a complete description, must have 2 or more bidders, and should be principally selected on price. The next section is the competitive method of procurement. So this is for everything over that simplified acquisition threshold or our policy. So we used $50,000 as an example before. So anything above that $50,000, we are going to need a formal RFP requested from multiple sources. Must be documented, must be a formal process, and it must consider other factors instead of just price. So then finally, the last method that we have available to us is a non-competitive proposal, and this actually isn't something we can choose to do. This was put in the guidance as a default for one of the 4 situations that may possibly arise when you are trying to procure. First, the item or service is only available from one source. The next would be a public emergency, so natural disaster. It would not permit the competitive solicitation process without a delay in implementation. The third one, the Federal Awarding Agency authorizes you to use specific vendors or contractors within the proposal process. So we like this one. If there are certain consultants that you know that you want to use, put that within the proposal for the award agreement. And finally, the last situation would be after trying to solicit a number of sources, competition is just determined inadequate. So in summary, for all of our methods of procurement here, you know, we see what has happened in the industry and what this very strict guidance is trying to get everyone away from is what we were previously calling a sole source. And what was happening was that we were saying, oh, we're sole sourcing this because we've worked with them in the past, or we've worked with them for so many years, and the procurement process was not being done at all. So you'll see that that whole rationale of, well, we've worked with them in the past, it really doesn't fit within any of these categories. So we really do want to make sure that if there is open competition, if there are other service providers, that we're getting an adequate number of quotations. All right, so some items in summary for our procurement. Again, document. We definitely want to document our procurement policies, our codes of conduct, mitigate against any of those conflicts of interest or disclosures. And as, again, we've mentioned a couple times throughout the presentation, these requirements do flow down to your subrecipients. So making sure that they are aware and that their policies are in compliance with these new requirements. We're going to establish who is responsible, the lines of authority within this whole process. So sometimes that could be both the finance and grants and contracts working together. It could be solely finance or solely grants and contracts, but making sure that everyone knows who is going to be responsible and really own this process. You want to define the contractor evaluation criteria. So it's, again, important to define those, but not limit those within our solicitation. We're going to perform timely and cost-price analysis to determine that it's fair and reasonable. And we're going to maintain the documentation of the whole history of our purchase transaction, including the selection basis of the award and the reasonableness of price. After we have selected our contractor, we are going to continue monitoring to ensure that they are performing in terms of the agreement. And we're going to address adequate competition. Finally, there's a section within the procurement guidance that talks about additional bonding requirements that could potentially be put in place. And again, this kind of focuses more on those construction contracts, but the Federal Awarding Agency could put in things such as bonding requirements in the form of bid guarantees or performance bonds. So it would be important to expand that section, your knowledge on that section, if that's something that your organization has. And finally, just reiterating what Terry had previously said, the procurement standards within the uniform guidance, they did come out and say that you can defer implementing these new standards for 2 years from your fiscal year end date. So the first year ends, which are the December 31st, 2014, which would have been subject to this, are going to now defer it through December 31st, 2015, so the first 15-16, and so the first year that they would be subject to would be the fiscal year 17. So on to our subrecipient monitoring. So we just went through the procurement, and we said a lot about contractor and what used to be called vendor. First and foremost, it's very important for the organization to have clear identification, clear processes in place to identify what is considered a contractor versus what is considered a subrecipient. So here we've just put one bullet point on each. The subrecipient would be the organization that uses the funds to carry out a program for public purpose specified in an authorizing statute. So this is a very this is a relationship that you're working closely with them to carry out programmatic details, whereas a contract is for the purpose of obtaining goods and services that they do all the time. Like, so you really have no say in how they're going to produce their good or service. You are contracting with them, whereas the subrecipient is very much a relationship of back and forth, and you have say and control over how they would implement certain aspects of a program. And the third bullet point is really important to talk about because it really is about the substance of the relationship. So what we could see is that, you know, you create an agreement and you say contractor, contractor, contractor all throughout the agreement, and you're like, yep, that's a contractor, I'm not subject to the subrecipient monitoring, but really the nature of the work is more of a subrecipient nature. So regardless of what it's actually called, it would truly be the substance of the relationship. So requirements for sub-awarding funds. You're required to clearly identify that those sub-award recipients are receiving federal funds. So all of those policy, statutory, and national policy requirements that your awarding agency gave to you, you are then in turn required to clearly communicate that to the subrecipients. You are also required to now perform a pre-award risk assessment, which we will touch on in a little bit, but ultimately, before we are handing over federal money to other organizations, it's important for us to make sure that those organizations have the internal controls in place to expend the federal awards in accordance with all of those national and statutory policy requirements. And then again, just making sure that any requirements are documented within that sub-agreement. Additionally, as the sub-awarding entity, you can also include other unique requirements for your subrecipient beyond the basic requirements of uniform guidance. So if you were to do that, that would need to be included in the award agreement. It is also very important to negotiate the indirect cost rate at the time of the award with your subrecipient. Just like we didn't spend any time on the changes in indirect costs, but there is this new concept of the 10% de minimis rate. So if that is something your sub-awardee is asking for, you would need to honor and negotiate that at the time of the award. Additionally, you would need to honor their NICR agreement if that is something that they had. And same with the federal awarding agency should honor that for you as well. You would want to make sure the subrecipient knows that you should be able to access the records and financial statements as necessary in relation to the funds that you are passing through to them. And if there are any requirements for closeout, you want to make sure that those are in the agreement as well. So back to that pre-award risk assessment. So before we even give money or decide that we are going to select a subrecipient to award federal funds, we're going to perform a risk for non-compliance of that organization. And that doesn't mean that, you know, if someone were determined to be higher risk that we could not award them funds. But all the risk assessment is trying to accomplish is what additional monitoring procedures are we going to perform based off of that risk assessment. So here we're seeing that maybe an organization has very good controls in place. They've had no findings in their single audits for the past several years under your program. They give you full receipts and support, and you know this based off of a history. That might be considered a low-risk subrecipient, and therefore your monitoring procedures might not be as extensive as another organization that might not have good controls in place. And why this is important is because ultimately, even though the funds are passed through to the sub, if any noncompliance occurs at that level or there's question costs, that flows back through your organization. You are ultimately liable for the management and compliance of that award. So back to that monitoring, some of the items that used to be should or suggested items, or even the things that we've been seeing are being done within the industry as best practices, the uniform guidance made these requirements. So now they've put some musts in for us. And, you know, we're happy to have done this because a lot of the organizations out there have been doing this for years. And now it's just a matter of formalizing the process. But in subgranting money, you must have a review of financial and performance reports. And this can be determined on, you know, a periodic basis or what works best for the size, complexity of your sub-agreements. But there must be some sort of financial and performance reporting back to your organization. You're also going to make sure you're following up on any deficiencies that they have had detected in their single audit. So if they have internal control findings in their single audit report, it's your responsibility to ensure that they're addressing those deficiencies through either on-site reviews or other means. So again, back to depending on that risk assessment, you may also consider doing other things such as provide training, technical assistance. You could do on-site reviews or have an internal independent auditor come in and do some agreed upon procedures. There could be multiple additional things that you implement on your subrecipients to ensure compliance based on that risk assessment. However, you must verify that each subrecipient is audited by Subpart F, so uniform guidance, single audit. So if your sub is expending more than $750,000 a year in federal awards, they too are required to have that Subpart F audit, and you would be then required to get the results of that audit and ensure there are no significant findings within your program. And again, if there are, what are you going to do to mitigate those findings? And then finally, consider taking action against those subrecipients that are non-compliant, because ultimately you are on the hook for the funds that you are passing through. Section 332 also talks about the opportunity for fixed amount subawards, and here it specifically says that it requires prior written approval from your awarding agency to get those, but they are an option if the awarding agency says yes, and it can only be up to $150,000. All right, and finally, I'm not going to go too much into detail on this, but the next several sections discuss record retention and access. So we still are required to maintain our reports and all our data and information for 3 years from the date of the submission of the final report. So, you know, usually your final reports are due 90 days after closeout of the grant, so 3 years and 3 months. Ultimately, you know, jumping down to 336, access to records, you know, just because a grant is closed out, that doesn't mean that they can't come back and look at those records, and they ultimately would be able to, and when I say they, your awarding agency or the Inspector General could come back and request access to those records at any time. And finally, the last termination, this section goes into any grounds, unusual situations for terminating an award. And finally, within the Subpart D closeout, they do emphasize that the closeout process is done in a timely manner so that we're not holding federal funds if you're required to send some money back. And one thing that was interesting is that within the new guidance, they did talk about the pre-award costs, incurring costs before the award starts, but they still they were silent on addressing the allowability of closeout costs. So the cost to, you know, you have staff time to put together the final reports and so maybe some salaries. They did not give guidance on that. However, looking at the guidance in others, there is an argument to say that some reasonable closeout costs for putting together final reports could be considered allowable. And finally, again, post-closeout adjustments, just because the award is closed out, that does not mean that subsequent audits, funder audits, IG audits could not come and question the allowability of costs and could reopen the grants for any question costs or things like that. And your final reports are due within those 90 days after the close of the award. All right, and with that, our Subpart D, I am now going to turn it over to Amy on Subpart E with our cost principles.
Thank you, Jen. I would like to first start by saying that we're almost in the home stretch here. We are just going to do an overview of the last two parts, which are Subpart E, the cost principles, and Subpart F, the audit requirements. But first we'll start with the cost principles, starting off with the general provisions. And this is some information about the cost principles. In the application of these cost principles are based on the fundamental premise that the non-federal entity is responsible for the efficient and effective administration of the federal award. The non-federal entity is also responsible for administering funds in a manner consistent with the agreement, with the program objective, and then any of the terms and conditions of that federal award, which would also include any special provisions that were included in the award. The application of these cost principles should not require significant changes in the internal accounting policies and practices. So what they're saying here is that they are assuming that you have good, sound internal accounting policies and procedures already in place, and that the application of the federal cost principles shouldn't change it that much. Now, that may be the case for some organizations. Other ones, it may require a little bit more work, but hopefully you're in the former and not the latter in that perspective. It does, however, mention as well in the general provisions that you may not keep any of the profit resulting from the federal financial assistance. Onto the application of the cost principles. In general, the cost principles must be used in determining allowable costs for work performed by the non-federal entity. And as we've said in several different areas, there are exceptions. They may be used as a guide for the pricing of fixed price contracts and subcontracts, but they do not apply to the following. arrangements under federal financing in the form of loans, scholarships, fellowships, traineeships, or fixed amounts based on education allowance or published tuition rates. For institutes of higher education, the capitation awards, which are awards that are based on case counts or number of beneficiaries. They do not apply to fixed amount awards. They do not apply to federal awards to hospitals. And if you need any more information on that, you can see Appendix 9 for further information. But basically, they do not apply to other awards which the non-federal entity is not required to account to the federal government for actual costs. And if you look at the definition, and I think Terry mentioned it earlier about fixed amount awards, that's actually a part of that definition as well. However, if you have a federal contract, you may be subject to CAS, or the Cost Accounting Standards. And these will incorporate applicable CAS clauses and standards and requirements per the CFR Chapter 99 and 48 CFR Part 30. So if you end up having an award that is, or a federal contract, you're going to want to refer to those cost principles and those cost accounting standards as well. There are some exemptions to the cost principles for some nonprofit or non-federal entities. They are listed in Appendix 8. If you, for some reason, would feel that your organization might be listed there, you could check. But for the most part, everyone is required to follow the cost principles. We're going to look at the basic considerations with the cost principles, and that basically starts with the composition of costs. So total costs equals the allowable direct costs plus the allocable indirect costs minus any applicable credits. So what is a direct cost? The direct cost is the one that is assigned specifically or positively identified with an award cost and can be assigned relatively easy with a high degree of accuracy. An indirect cost is the cost for the overall operation of the organization, but is not specific to that one cost objective. So these ones are basically not readily assignable to cost objectives that are specifically benefited. And to facilitate the equitable distribution of an indirect cost, the non-federal entity may establish a NICRA, or a negotiated indirect cost rate. And as we have mentioned, I think a little bit earlier, these must be accepted by all federal awarding agencies. You must have gone through the process to apply for the rate, there's been negotiations, etc., and once approved, then all the federal agencies have to follow that rate. There is also under uniform guidance the 10% de minimis indirect cost rate. This is for those non-federal entities that have never received a NICRA in the past. They've now allowed for this rate to be put into awards instead of going through the negotiated indirect rate process. And then the applicable credits. These refer to receipts or reduction of expenditure type transactions that offset or reduced expense items allocable to the federal award as either direct or indirect. So an example of a credit are possibly purchase discounts, rebates or allowances, insurance refunds, adjustments of overpayments, or maybe just some erroneous charges. And in some instances, the amounts received from the federal government to finance activities or service operations of the non-federal entity should be treated as applicable credits. In moving on, we'll discuss the factors affecting the allowability of costs. So costs must meet the following general criteria, and the first is necessary and reasonable, and I think we hear that all the time. So what does that mean? A reasonable cost is one that in its nature and amount does not exceed what would be incurred by a prudent person. You must consider if that a cost is ordinary and necessary. And by necessary, that would mean it was needed for the performance of the award. And under the necessary and reasonable clause, again, we go back to our sound business practices used. You would want to consider market prices for comparable goods and services. All of these will round in a manner and bring you to what if the cost was necessary and reasonable. The cost must conform to any limitations or exclusions as noted in the circular. And this one is important. the treatment of cost must be consistent with the policies and procedures that apply uniformly to both federally financed and other activities. So what this is saying is that they would really want you to treat your costs the same, whether it's for a federal program or a non-federal program. And in addition, they have to be accorded consistent treatment. So you may not assign a cost to a federal award as a direct cost if that same cost is incurred for maybe a similar purpose in a like circumstances and has been allocated as an indirect cost. So if you have a conference that has to deal with your award and you've charged that as a direct cost, you can't turn around and then a month or so later when you have a similar type item, put that in as an indirect charge. You have to be consistent with the way you've decided that the treatment of a cost is. It must be in accordance with GAAP, except for the state and local governments and Indian tribes. Costs cannot be included as cost or used to meet cost sharing or matching requirements of any other federally financed program in either the current or the prior period. And of course, they must be adequately documented. And we're going to look at the 54 cost items that are specifically addressed in CFR 200. These are many that are commonly encountered in the course of doing business. There are a number of items in this list that are explicitly prohibited. For example, the one everyone knows is alcoholic beverages. And in the items specifically addressed, OMB actually had provided some additional interpretation as a part of the grant reform comment process. And an example of this is the fluctuation of exchange rates, which we will also talk about when we look at these. But it should be noted that failure to mention an item in these 54 cost items that are specifically addressed doesn't imply that either that item is allowable or unallowable. Rather, you must look at that item, find a similar item, and look at the treatment of that and decide whether it should be allowable or unallowable in conjunction with looking at the general principles and the factors of allowability that we just discussed. So, the 54 items that are addressed specifically, they are in section 420 to 475. And these ones listed here on slide 39 really have not had any changes, or little or no substantive changes. Still very uniform as was before. It has the alcoholic beverages, the bad debts, things like that that are specifically prohibited. The next slide is items that have, lists items that have changed. So I would suggest, because I'm not going to go through every one of these, but I would suggest that you review this list, and if there is one here that affects you, that you specifically pull out the CFR 200 and take a look at specifically what has changed and what may affect you. But we will look at a few of the more important ones. The first one is on compensation. And for a nonprofit, the compensation is for personal services. It's not a distribution of excess earnings, so it does include effort reporting. It does call for an after-the-fact determination of what occurred. Organizations, if they're using an estimate, must reconcile that estimate with the actual effort, and they must have a well-designed system of internal control. It basically, 430 says it must be based on records that accurately reflect the work performed. It also clearly states that budget estimates alone do not qualify as support for charges. So I think at the beginning of this process, a lot of people were talking about possibly getting rid of their timesheets. And when the final iteration of the uniform guidance came out, it never really said that you could, in theory, get rid of your timesheets. It basically says you have to have some sort of effort reporting and it must be adequately documented. So I think for the most part, most of our clients are continuing with their timesheets because no one has adequately come up with a way to formally document this in a manner that they feel will be accepted at this point by the federal government. Maybe someone will come up with something, but at this point, everyone is still continuing to use their timesheets. Section 432 is on conferences. And this really is just, I think, to underscore that costs must be reasonable. They must be based on what the attendees are paying to attend, the number of people attending, that it must be reasonable and necessary and managed in a manner that minimizes costs. Now, I'm not sure if this was highlighted because of the scandal that happened in Las Vegas in the fall of 2012, but it definitely, that was a high-profile case, so they have added some additional language in this section to ensure that the non-federal entities aren't taking advantage of their conference expenses. Section 436 is on depreciation, and while it still allows for depreciation, you no longer can charge a use allowance. And Section 438, entertainment. While this is normally unallowable, if the activity has a programmatic purpose and it has advanced approval from the awarding agency, it may be considered an allowable cost. And then Section 474 on travel. There's a lot of information in this section, so it's definitely one that I would highly recommend that you look at. But some highlights is that you can include the cost of temporary dependent care that the traveler incurs if it is a direct result of the individual's travel for the federal award. It does discuss the allowability of commercial airfare, and again, it must be the basic least expensive airfare. If it is in excess of that, it can become unallowable. And there are a few exceptions to that, again, listed in here. One of those is based on medical need, but it says if you do have one of those exemptions, you must justify and document that on a case-by-case basis. Another important item under the travel principles is that they have dropped the prior approval for foreign travel. Then there are some new principles and ones that are no longer addressed. 428 is the collection of improper payments. So they're saying now that the cost to recover improper payments are allowable, and then any amounts that may be collected can be used in accordance with the cash management standards. Exchange rates. They have also identified in Section 440 that the cost increases for fluctuations in exchange rates are allowable, subject to the availability of funding. And prior approval is needed only when the change results in the need for additional funding or that increased cost significantly reduces the scope of the project. And you will want to determine that before the end of the expiration period if you, by chance, would need prior approval. Section 448 is on intellectual property, and this gives a list of allowable costs for securing patents or copyrights. And then you can see there on the right, there are a few that are no longer specifically addressed. The allowability of specific staff positions, communication costs, labor relation costs, meeting, and foreign travel. Okay, so that was the overview on Subpart E, the cost principles. I'm going to give another quick overview on Subpart F, the audit requirements. And I think as we mentioned a little bit earlier as well, an audit is required for non-federal entities that expend $750,000 or more. And again, a non-federal entity includes states, local governments, Indian tribes, institutes of higher education, and non-for-profit organizations. There's also the program-specific audit requirement that can be used if you only have one federal program. And the terms and conditions of the award do not require a full financial statement audit, so then you just audit that one program. This may not be elected for R&D, though, unless all of the federal awards expended were received from the same federal agency or the same federal agency and the same pass-through entity, of which has to be approved in advance. Non-federal entities that expend less than $750 are exempt from the audit process under uniform guidance or from Subpart F, but records have to be available for review or audit by appropriate officials of the federal agency, the pass-through entity, and the GAO. So just because you fall under the $750,000 threshold doesn't mean that all these standards and principles and the uniform guidance do not apply to you. They still apply to you, and you want to make sure that you have them implemented in case a federal agency comes to review them. The basis for determining federal awards. So this is determining that $750,000 and how you value some of these items. So those federal awards must be based on when the activity related to the federal award occurs. They must comply with the federal statutes, regulations, and the terms and conditions of the federal awards. And it can consist of the expenditures or the expense transactions associated with awards that include grants, cost reimbursable contracts under the FAR, use of loan and loan guarantee programs, the receipt of property, the receipt of surplus property, the receipt or use of program income, distribution or use of food commodities, and the disbursements of amounts entitling the non-federal entity to interest subsidy in the period when insurance is in force. So for loan and loan guarantees, this is still a risk of the government until the debt is paid. So to calculate the value of the federal awards expended, you must use the value of the new loans made or received during the year, plus the beginning of the audit period balance of loans from previous years when the federal government imposes continuing compliance requirements, plus any interest, subsidy, cash, or administrative cost allowance received. Prior loan and loan guarantees, you only include those when there is no continuing compliance requirements. Loan and loan guarantees at the institutes of higher education. When a loan is made to a student of an institute of higher education, but the institute of higher education does not make the loan, then only the value of the loans made during the audit period must be considered a federal award that is expended. And then the balance of loans from prior audit period are not included because the lender accounts for the prior balances. Endowment funds basically include the cumulative balance of federal awards for endowment funds in each period are considered for the federal awards expended. And then your non-cash assistance, the free rent, food commodities, donated property, those are valued at fair market value. It is important to note, though, that free rent received by itself is not considered a federal award expense unless received as a part of an award to carry out a program. Medicare is not considered a federal award. Medicaid is not considered a federal award unless states require it. And then certain loans provided by the National Credit Union Administration could be considered federal awards expended for this purpose. And once you've decided and figured out all of your federal awards, then you see if you are over the $750,000 threshold, and then comes in some more responsibilities. So first you must procure the audit and allow that auditor access to all the information to be able to perform that audit. You must follow the procurement standards, so the ones that Jen just discussed in Section 317, and as a reminder, you do have that 2-year delay for that. But there is a restriction placed on auditors preparing indirect cost proposals. You cannot hire an auditor to do your audit who has also prepared your indirect cost proposal if the indirect costs recovered by the auditee during the prior year exceeded $1 million. In addition, the auditee is responsible for preparing the financial statements, which are the same organizational unit in the fiscal year. They may include, the non-federal entity statements may include other department agencies and other organizational entities that have separate audits. And here's a must. You must establish internal control systems that should be in compliance with COSO or GAO, the Green Book, as Jen discussed. And GAAP is not required. However, an auditee cannot be considered a low-risk auditee by the auditor if they voluntarily follow a non-GAAP basis. So there are some times where a state may require you to prepare a non-GAAP basis statement. That will not preclude you from being considered a low-risk auditee. Also, the auditee is responsible for preparing the Schedule of Federal Awards, or the CFA. It must be for the same period as the financial statements. And as we are trying to encourage our clients, when they prepare that CFA, to go through and identify if the award that they're looking at applies to the uniform guidance or if it's following the old circulars. But at a minimum, the CFA must include on the face of the CFA the following: the federal grantor, the pass-through grantor, program or cluster title, the CFDA number, the pass-through entity identifying number, the total dollar amount expended, the total amounts provided to subrecipients, which used to be disclosed in the notes but now has to be on the face, and then the total awards expended for loan or loan guarantee programs. Any non-cash awards, that free rent or free commodities that we discussed, and then the total for the cluster of programs. And now the notes to the CFA must include the following: the basis of presentation, the cost principles used, and this is one that could potentially be both principles. So you may have awards that are following A122, and you may also have awards that are following Title II under uniform guidance. So in this disclosure, there could potentially be a reference to both of these cost principles. And then the notes must also include the loan balances outstanding at the end of the audit period for loans and loan guarantees, and then whether or not the federal entity elected to use the 10% de minimis cost rate. In addition, there are still more requirements for the auditee. The auditee must promptly follow up and take corrective action on all audit findings, and there are some general requirements here. The auditee must prepare a summary of prior year audit findings and a corrective action plan, and these are two separate things, and we're going to go into those. But they must include the reference numbers that the auditor assigns to the audit findings. They must include the fiscal year in which the finding initially occurred. They may include audit findings from multiple years, and it must include all findings, including those related to the financial statements reported in accordance with GAGAS. So the summary of prior year audit findings. This must include the current year status of all the audit findings and question costs. It must include audit findings reported in the prior audit's summary schedule of prior audit findings. When an audit finding is fully corrected, it will list that audit finding and state whatever the corrective action that was taken or put in place to correct that finding. If the finding has not been corrected or was only partially corrected, the auditee must disclose the reason for the recurrence of that finding and the planned corrective action to fix that, and then also disclose any of the partial corrective action if it's partially completed. If the auditee believes the finding is no longer valid, they must provide the reason for this position. And as a part of our audits at Gelman, Rosenberg, and Friedman, we are asking our clients to put this on their letterhead to clearly show that it was a document that they prepared, because it will be then put together with our reporting package and included in the financial statement package. So it's very clear that the auditee has appropriately prepared that, that schedule. And then there's a corrective action plan, which is, again, a separate document from the auditor's findings, and it must address each finding included in the current year auditor's report. It includes the name of the contact person responsible, the corrective action plan, and the anticipated completion date. If an auditee does not agree with the finding, they must include that explanation and specific reason on this document. In addition, you must always provide the auditor with access to records, and then you must submit the report and data collection form the earlier of 30 days after receipt of the auditor's report or 9 months after the end of the audit period. The audit team must make the copies available for public inspection and ensure the respective parts don't include any protected personal identifiable information. The Federal Audit Clearinghouse is the repository of record for Subpart F, and you must follow the instructions on the data collection form, which includes the submission of the reporting package. Now, this reporting package has to be certified by a senior level at the auditee's organization. There is an exception for Indian tribes. However, the reporting package must include the following: the financial statements in the CFA, the summary schedule of prior audit findings, the auditor's report, and the corrective action plan. And these will be basically uploaded as one document to the Federal Audit Clearinghouse. Then the auditee electronically submits this to the Federal Audit Clearinghouse. If they request, you must submit the management letter as well. And it's also required that the auditee keep one copy of the data collection and reporting package for 3 years from the date of submission. There are some other items of requirements that you, as the auditee, will want to be aware of, and that is taking a look at the 2015 compliance supplement. This is effective for audits fiscal years starting with fiscal year June 30, 2015. And it is something that the auditors use, but it's something that the auditees may have to be aware of in order to be in compliance. And part 2 is where some of the changes have come into place, is the updated matrix for compliance requirements. And there used to be 13 compliance requirements. They have removed Davis-Bacon Act and the real property acquisition or relocation assistance. They're actually still here. They're just shown as reserved. You can see it, D and K now say reserved. But in theory, Davis-Bacon Act it's completely removed from the basic 13, but if there is an instance where this would come into play, they would basically add that to your award as a specific provision. But we no longer have to address those, and as I said, they did not change the lettering. They wanted to keep the lettering consistent, so they are now just marked as reserved. In H, period of performance, this was just a title change. It used to be called period of availability. But you could go through and look at the compliance supplement. They have given some additional guidance in a lot of these compliance requirements. So it is important to look at those and see what additional information is provided for you. Part 3 of the compliance supplement is now broken into 2 parts. We have section 3.1, and this is used for the testing of awards that are subject to the OMB circulars. And then there's section 3.2, which is for those that are subject to the Uniform Guidance, Administrative, and Cost Principles. So for example, you may have a couple of awards, some which were prior to the issuance and fall under OMB Circular A133 or A122, and then you have others that were issued after December 26, 2014 and fall under Uniform Guidance. And let's say they both have subrecipients. So you have basically could potentially be treating those different prior to Uniform Guidance and after Uniform Guidance. And we would be looking at that as a part of the audit process and testing them in 2 different manners to make sure that you are in fact in compliance with 3.1 and 3.2 for each of those individual awards. Now there are auditor requirements. We must conduct the audit in accordance with GAAP and GAGAS. We must determine whether the financial statements are fairly presented. We must understand the internal control over federal programs and plan to support the audit, to support a low assessed level of control risk. And as a part of that, we have to determine our major programs. And the threshold for determining a Type A, Type B program has been increased under Uniform Guidance. It is now $750,000. It used to be $300,000. There was a lot of confusion between the $300,000 and the $500,000 threshold that used to require an audit. So now they made them the same number. It's $750 that triggers an audit, and it's $750 that is a Type A program. There is a table, just like there used to be, that if you exceed $25 million and above, your Type A threshold will increase according to that table. But once you've determined your Type A and your Type Bs, then you have to do a risk assessment and determine your low-risk Type A's, your high-risk Type B's, and there's basically a 4-step process you have to follow to identify what then will be considered your major programs. And if you qualify as a low-risk auditee, you potentially could only have to audit 20%, but if you do not, your major programs have to be at least 40% of your total federal awards. Now, in the audit finding piece, just as a reminder, auditors must report the following as audit findings: significant deficiencies, material weaknesses, known question costs greater than $25,000 for a major program. And then you don't have to test, but if you become aware of known question costs greater than $25,000 on a program that's not major, that must also be reported as an audit finding. And then if there are circumstances why the report on noncompliance is other than modified, you would have to report that unless it's already otherwise reported in one of your findings. Any known or likely fraud is an audit finding. And then one thing I wanted to mention that is if in the summary of prior year audit findings prepared by the auditee, if a finding is materially misrepresented, you may say the finding has cleared and there's clear indication and documentation that it's not cleared, that actually could be considered a new finding. And Section 516 also gives some clarity, some information about finding detail and clarity and what has to be included. And then finally, on the last slide here under Subpart F, just wanted to give you a little bit of background. I mentioned about the low-risk auditee where you can qualify for the 20%. An auditee must meet all of the following in each of the 2 preceding audit periods to be considered a low-risk auditee. So there must have been a single audit performed on an annual basis in accordance with GAGAS, including submitting that data collection form on time. There must be an unmodified opinion on financial statements in accordance with U.S. GAAP or basis of accounting required by state law. You must have an unmodified in relation to opinion on the CFA, no material weaknesses in internal control over financial reporting, no going concern, no waivers, and those 2 are new under uniform guidance. And then none of the federal programs classified as Type A programs had internal control deficiencies identified as material weaknesses. Can't have a modified opinion on major programs in the auditor's report, and cannot have known or likely question costs that exceed 5% of the total federal awards expended for Type A programs during the audit period. That is an overview of Subpart F. I am going to turn it back over to Trevor and go through any questions that have arisen throughout the process of the webinar. I'm not sure if Trevor is there.
Nope. Amy, we could just answer the questions that's popped up. I think one of the questions definitely has come up on my slide on procurement about the micro purchase thresholds. The slide says 3,000, which was originally the threshold that was set when uniform guidance came out. But that was later raised just a few months ago to 3,500. So 3,500 is the actual threshold, and we will make sure to update that on the final slides before we send it out to all of our participants upon completion of the webinar. There was also a question on whether the agency can approve a vendor without the formal RFP process or solicitation process. So, for example, the agency would tell you who they want you to use or hire. And yes, this is definitely something the agencies can do. And in that situation, you would be required to use who they said and would not be required to go through the whole procurement process. And finally, there was a question on whether we'll be expanding our discussion on the remedies for noncompliance. And this is surrounding kind of the just your remedies if you were noncompliant, or maybe for your subrecipients. And we're not going to get into too much detail, but I do suggest taking a look at that 338 section. And I do suggest taking a look at that 338 section, and they give you some guidance as to the remedies that you could follow for noncompliance. The first and foremost being, if there's a way to fix it, you would most definitely do that immediately. And then the guidance also goes into ways that if there is ultimately no way to fix it, what ultimately could happen or what ultimately should be done. And with that, ultimately you want to have open communication with your funding agency. If something happens, make them aware immediately, be transparent, and usually they're really great on working with you if you quickly identify the problem and work with them to fix it.
And Jennifer, this is Terry, I'll just kind of follow up on that as well. It does specifically say that a non-federal entity, if it does fail to comply with the federal statutes or the regulations or the terms, that the awarding agency or the pass-through entity may impose additional conditions in relation to that particular grant. So, for example, if you are the pass-through entity and you've granted that down to a sub-awardee, you could do additional site visits to the entity. You could ask for more reporting. You can take a specific look at what exactly the issue is and then put steps in place to get that resolved. And as part of that, you could temporarily withhold cash payments pending correction of the deficiency by the non-federal entity. You could disallow all or part of the cost as a disallowed cost as part of that. So the section does give you a little bit more guidance around that area.
And Terry, I'm going to jump in on another question for the pass-through entity identifying number required on the CFA. Basically, what we've come to learn with most people trying to find out what this identifying number is that they're looking for a pass-through grant number. It's not the DUNS number or a number but it's a number that you would get from the organization that passed the money through to you. And for the most part, people are looking at some sort of sub-agreement number or identifying number that is clearly on the award.
Very good. So if we all could just maybe say one quick item, I think we have like 3 minutes left. So as part of my discussion in the very beginning of the presentation today, the one takeaway that I do recommend is really understand the effective dates, because Subparts A through E is conditioned on when that award was issued, if it was issued after December 26, 2014 or before, and of course those funding increments. And we have seen throughout the year that the different federal agencies are treating those funding increments not consistently. Jennifer, do you have a takeaway?
Sure. Well, since mine was very much on the procurement and subrecipient monitoring, I think the biggest takeaway there is making sure that you have the policies and procedures in place and that these are being communicated to the effective and the key players within that process of the organization. So, you know, some organizations could have multiple players in multiple offices doing these things. So making sure that there's open communication there on the new policies, procedures, and that everyone is actively trying to comply with the new uniform guidance.
Terrific. Amy, how about you?
And I have two, I think, that are important key takeaways, and that is preparing that CFA ahead of time and getting it to the auditor and identifying if the award falls under the old requirements or under the new uniform guidance, because that's going to be key in determining the audit plan and how things are tested or classified as major. And then also, because I think it's new, is that summary of prior year audit findings and making sure that you've adequately prepared that document and have it ready with your corrective action plans.
Excellent. Well, thank you everyone for attending the presentation. Please do not hesitate to contact us. I think the last slide here does give our contact information, and we wish everybody a very good day. Thank you.